Hello and welcome to Macros with Mythili, our weekly show where we take a hard look at some of the major macroeconomic developments and issues. On the macroeconomic front, September was a crowded month. We had both the FOMC, that is the Federal Open Markets Committee meeting, as well as the RBI's fourth bi-monthly policy announcement. Both events were eagerly awaited. While the Fed meet had world markets waiting with bated breath, the RBI's meet was just as eagerly awaited, but by domestic players. In the event, the Fed opted for status quo, while the RBI opted for a far more aggressive stance. How does one read the divergent stances of the two central banks? Remember, the actions have a huge impact on both growth and inflation in India. Helping me join the dots is a panel of experts. We have with us Anant Nageswaran, who's had a long innings in banking and keeps a close eye on both global macroeconomic developments as also in India. He joins us from Singapore. We also have Anant Narayan, co-head Wholesale Banking South Asia, Standard Chartered Bank, and S Vishwanath, former Managing Director, State Bank of India. Welcome to the show. My first question is to you, Anant, in Bombay. Prior to the announcement by RBI on Tuesday, there was a fairly widespread belief that both the RBI and the Fed are behind the curve. The Fed in raising rates and the RBI in cutting rates. But now that the RBI has cut rates far more aggressively than expected, has it made up for lost time with a more aggressive cut? Or will it be a case of too late, if not too little?
Well, given the size of the cut, Mythili, I think it is about just right. The market, if you remember, was completely positioned for a 25 basis point rate cut, followed by some hawkish kind of noise indicating that further rate cuts will be very, very data dependent. On the contrary, we got three things. One, we got a much steeper than expected 50 basis point cut. Second, we got a fairly dovish guidance going forward, indicating a 4.8% inflation for Jan 2017 was below what economists were expecting. And third, they also opened up the FPI quota, which indicates there'll be more demand for government bonds and therefore yields can come down a lot more sharper. And of course, they also put a lot of stress on transmission of rates, which I think they'll work on to ensure that the lending rates come down as well. So it's been a huge catch up and clearly a lot of relief to a system which is stressed with balance sheet issues on corporates and banks, which is crying out for relief. So in a sense, therefore, I believe it's been a huge catch up and something that the market should be delighted with.
Okay, now let me turn to Anantha and Anant ask him the same question. Anantha, has the RBI made up for lost time by giving a more aggressive cut than what the markets anticipated?
The governor wanted to basically get the maximum possible bang for the rate cut. So he has always cut rates with a surprise element. So probably in the last few months when the market was looking for a rate cut, or maybe even 50 basis points, he didn't deliver them. But when the market was expecting 25 basis points, he had chosen to deliver 50 basis points. And it might have also taken some time for him to get the government on board with respect to the reduction in small savings rates, etc. So he might have waited until some mechanisms were in place for the transmission of monetary policy to happen through government's cooperation in addressing the public sector banks, reduction in lending rates and deposit rates, the small saving rates, etc. So I think he went for two elements. One is a surprise element, which hopefully magnifies the impact of the rate cut. And second, he probably was waiting for many coordination issues to be sorted out before he delivered the rate cut. So to me, these two factors explain the slightly higher than expected rate cut magnitude yesterday.
Okay. Anant, this is to you in Bombay. Does the RBI's latest action, as well as a more dovish statement accompanying the policy announcement, reflect a welcome realization that a focus on inflation alone at the cost of other macro fundamentals could prove costly beyond a point? And is it an unstated admission that despite being formally anointed as an inflation targeter, it needs to look at many more indicators, something that the Fed chairperson Janet Yellen's recent speech in Amherst acknowledges far more readily? In fact, she says, and I quote over here, she says inflation controls is only half the dual mandate that the Congress has given, the other half being employment generation and maximum employment. Would you agree that this reflects a welcome realization on the part of the RBI?
Look, Mythili, I'll give you a couple of perspectives, right? For one, the RBI can continue to say that they are following the Urjit Patel framework, because after all, if they're indicating a mean expectation of 4.8% by Jan 2017, even going by the logic of 150 to 200 basis points higher than that as the repo rate, they can still justify, a 6.25% eventually as the terminal repo rate. So given that they are saying they expect inflation to be a lot lower given the global commodity cycle, they can stick to the fact that they are sticking to that old Urjit Patel framework. Having said that, I completely agree with you. I think being solely focused on inflation, particularly in an economy like India, where a big part of the headline CPI is anyway food, 46% is food, and it's very tenuous as to how much of aggregate demand is actually impacted by interest rates, given only 20% of the banking book goes out to retail loans. I think you have to look at a whole host of factors, including what's happening on foreign exchange stability, what's happening to capital flows, what's happening to the stress in the banking and corporate balance sheets, what's happening to the investment cycle, what's happening, of course, to WPI and CPI. You have to look at a whole host of factors and then decide what the right appropriate monetary policy approach ought to be, both on rates as well as on liquidity. We are hoping that as time goes along, this realization dawns and maybe there's a relook at the overall monetary policy framework. Having said that, even under the current monetary policy framework, the governor has pretty much delivered what the market is asking for, so I guess we can't complain.
Well, I guess so. We can't complain, but really the RBI needs to look at many balls which are up in the air. But Vishwanath, if I can turn to you now, since you've been in hardcore banking, one of the issues that the RBI always talks about is a lack of transmission. And here it comes to the issue of the marginal cost of funding. Is it feasible in today's scenario where deposits are really contracted at fixed rates while loans are extended on a floating rate basis? Can the RBI be telling banks that you should go by marginal cost of funding? In fact, should the RBI get into the business at all of telling banks how to price their loans? I thought that kind of micro-regulation had gone out post-reforms, and it is competition rather than RBI diktat which should determine how loans are priced. But where are we at today?
Well, I look at it like this. I guess RBI was under tremendous pressure to reduce rates, and RBI, I mean the whole market was talking about, the government was talking about transmission, and the RBI themselves thought that whatever we gave should have been transmitted, and we are not the only guys who are spoilers. I mean, that is the kind of the whole outlook that was. And in that context, I think they've said that, the transmission should be much better than what it was. But let's put it in context. In India, most banks have got stable deposits, and that is their mandate. Actually, they're running around from village to village, all over towns, competing with banks to get their CASA deposits and term deposits, and they really pride themselves in having these kind of stable deposits rather than go to money markets for borrowing or have some other method of borrowing which brings them closer to market on a day-to-day basis. Now, these deposits, like you said, are for longer maturities. They could be for 10 years, where we wanted to promote 5 years and above deposits because we wanted to do infrastructure loans, and we wanted some kind of asset liability matching of a higher order. So we went and contracted higher term deposits and so on. I mean, this is the deposit taking and the deposit gathering was a big activity, and we have done very well, and we have set up branches to do that. Now, this whole thing about marginal cost seems to negate that whole effort that has gone into the deposit gathering machine. Now, what is being said in the Reserve Bank's policy is that you can have whatever deposits you have, you put them in various brackets, but apply today's relative rate to each one of them, calculate your cost, and then they're also prescribing a whole lot of other things. Precisely what you said, why don't we leave it to the market to decide? And if these guys price it higher, they're anyway going to be thrown out of the market. So why not we permit that with a kind of cutthroat competition that is there in the market? Nobody can price his loan at a rate which is much worse than what his cost of funds is. So why not leave it to them to do this? Instead, what they've said is, you put them in various brackets, put current rates on top of each one of those, even though much of your deposit in that bracket belongs to what we took 3 years ago. And you calculate your average price based on that and base your base rate on that. So what they're saying is, apply to the loans portfolio, existing as well as old, the new rates that are being computed based on today's rates, whereas for the depositors you pay them whatever you contracted with them earlier. This is obviously in a falling interest rate scenario not very palatable to banks, but all that I'd like to say is, in a rising interest rate scenario, banks would welcome this, and at that time maybe the regulator or whoever is prescribing these kinds of numbers would have to come and change his whole methodology and go into a reverse methodology, which obviously is not what is intended. So given this, we have to admit that in a scenario where bank finance and the bank borrowing and the bank deposit taking is the major part of the financial market activity and not the bond markets or not the borrowing and lending in the money market. That's not the most major activity of a largest segment of players in the financial market. We are going to have delays in transmission, and those delays, we have to kind of swallow it. We can't help. But there are other things which we can do in terms of building a corporate bond market, in terms of incentivizing or pushing people into these markets and developing this market and strengthening, deepening these markets, bring in liquidity, etc. We can work that, and once that happens, then obviously the transmission will be much faster, much quicker.
So clearly what the RBI wants is a very ideal situation which doesn't exist in India today, and they need to get a little pragmatic as far as pricing of loans is concerned, and best is to leave it to the market. But I'm afraid on that note, it's time for us to slip into a very short break, but please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're trying to look at the RBI's bi-monthly policy statement which came on Tuesday and juxtapose it with the Fed stance and trying to make sense of it. Anantha, this is to you in Singapore. Let me go back to what Janet Yellen said in her speech, where she made a surprising and rather humble admission for the head of the most powerful central bank in the world when she said, economists' understanding of the dynamics of inflation is far from perfect. In such a scenario, is the faith of the RBI in targeting inflation, especially when it's based on a consumption basket where close to 50% is food, is that kind of faith misplaced? After all, the RBI has very limited influence over food prices, where the ball is largely in the court of the rain gods and the government.
No, I think forget about the weight of food in the basket, regardless of whether it is 50% or 20% or 15%. I think the real issue is central bankers do not really have much of an influence on the evolution of inflation and on the formation of inflation expectations among households and firms. It's been recently proven with a survey of firms in New Zealand, while surveys of chief financial officers in the US corporate sector also has shown that their hurdle rate remains the same for a long period, regardless of whether monetary policy interest rates come down or not. The only time when a central banker really managed to tame or even slay inflation was in the early 80s when Paul Volcker was able to raise interest rates to punitive levels. And he was able to do so only at the cost of engineering an economic recession, two of them in succession almost, with a small gap of 1 year in between. So strictly speaking, the remit of central banks in terms of controlling inflation, whether it is dictated by food or government policies or by other considerations, the truth is central banks have very little control over inflation dynamics. And that applies to developing countries, it applies to developed countries. So the only thing they can look after properly, or they should focus on, is ensuring economic and financial stability by controlling the flow of credit into the economy, both from the banking system and from outside. That is all that they can do and do efficiently, because the inflation dynamics is not in their control. Whether they are following twin objectives or single objective, it does not matter.
Okay, Anant, I think your counterpart Anantha in Singapore has a very different perspective of central banks' ability to control inflation. He sees them as lesser gods. But if I can now shift to another part of the monetary policy statement, as I see it, there are two main parts to the statement. One is, of course, the interest rate action, and the other is a rather dramatic relaxation in the foreign portfolio investment limits. In relaxing the limits, the RBI has tried to do a very careful balancing act, trying to balance the fallout of any possible Fed action, which would definitely result in capital outflows, with providing some kind of incentives for fresh inflows. FPIs have therefore been allowed to increase their holdings hugely by 120,000 crores till 2018, and this is almost the entire amount that they are allowed right now. Does this make us a little bit more vulnerable on the external front? Because even though it is only about 5% of the outstanding government debt, mind you, our forex markets are very thin, and if they decide to exit, it could have huge consequences. And will this really be good enough to prevent the outflow?
Right, Mythili. Before I answer the question on FPI, just a quick clarification. I think Anant Nageswaran is pretty much repeating or echoing my sentiment. I completely agree with him that the inflation dynamics and the control that central bankers have on inflation is limited, particularly in an economy like India, as I said, where it's not a borrow and spend economy. We don't actually, you can't control aggregate demand by controlling credit beyond a point. But coming to your question on FPI, look, my take is slightly different. First, if you look at the actual ownership of foreigners in the equity markets, 24% of Nifty stocks are held by foreigners. If you limit it to the actual free float, 48% of free float is held by foreigners. And against that, in the debt markets, we have a paltry 3.7% of outstanding be held by foreigners, and that too of government bonds, right? We've always had this lopsided approach where we have over $350 billion of foreign ownership in equity markets and only about $65 billion of ownership in debt markets, including corporate bonds. So to me, a shift where you increase foreign ownership in government debt is actually welcome, given the premise that we actually need foreign capital. Let's face it, we require a huge amount of capital coming from overseas to fund our infrastructure, to fund Make in India, to fund manufacturing, to fund employment. We don't have a choice, right? And that fund should come in all fungible forms, whether it's FDI, whether it's equity, whether it's debt. If it comes in the form of debt into government debt, it frees up domestic savings through banks to actually be invested into productive investment opportunities, including infrastructure. So to me, you need a whole mix. Now, the number might seem large, but as you rightly pointed out, it still will be only 5% of the overall outstanding debt, which is very, very small in the overall scheme of things. But I do agree that you require a few caveats and a few safeguards to be built in so that we don't have a repeat of what happened in June 2013 after the Fed taper tantrums, where we saw $6 billion of money going out from debt markets and creating havoc in the rupee market. One, there are already a few safeguards. If you recollect, the RBI has put tenor restrictions to ensure that anybody investing into the government debt markets has to invest in a minimum residual maturity of 3 years. So you bring in serious people rather than arbitrageurs. Second, you also have the RBI limiting a lot of the increase to sovereign wealth funds. Now, these are typically, buy and hold kind of investors who will be there for a long, long time and not really trade and arbitrage the markets. Third, which we need to work on, is just as you have index inclusion in the equity markets, we are part of the Morgan Stanley indices and so on and so forth. We need to ensure that government debt particularly falls into certain indices which are tracked by global fund managers. If we can do that and solve that conundrum, which I know we've been working on for a long time, you will ensure that all global fund managers, including real money, pension funds, insurance companies, will bring money into India merely as a percentage of their allocations, and that will be extremely stable. So alongside this increase, which I think is extremely welcome for bond markets and for the economy as a whole, we also need to work to ensure that Indian bonds become part of the global indices and therefore bring real stability into the size of the flows.
Anant, I would have agreed with you on most of what you said, except for one thing, where the opening up has been done in almost entirely only in government securities, and these are entirely risk-free. I would have no problem if we opened up on the corporate bond side, but whereas what we are seeing is that foreigners have happily lapped up the limits open under government securities, but they're only about 76% utilize what is available under corporate bonds. So my query to you is, would it not be good if foreigners were willing to take a call on our corporate bond market and expose themselves to credit risk also, rather than looking only at sovereign debt?
I'll quickly respond to that, Mythili. Look, as I said, we need a whole plethora of investments, whether it's government or it's corporate debt. Let's face it, we have got money through the corporate bond route as well. We also get money in bilateral form through ECBs, etc. So there's enough money coming in from overseas on the corporate side debt as well. I don't really mind if money comes into government debt, which is after all pretty cheap. It's the lowest rate. It's the best deal that, it's the lowest deal that we can afford to pay. It just frees up local money and savings to be invested into corporates, to be invested into, infrastructure, into profitable investments. So let's face it, rather than have overseas investors take a call on infrastructure, take a call on completion and construction risk, I'd rather that the local Indian banks, which understand this far better, price that better and use their funds and savings to deploy in those sectors, and let the foreigners take the government debt, which after all is pretty cheap, at 7.5% yields. It's the cheapest way of raising money for us. So I really don't mind that.
Yeah, that's true. It's difficult for us to understand ourselves. So I doubt if foreigners can really understand us, particularly the infrastructure sector and the glitches that we've seen there. You're right on that, Anand. But Vishy, one more thing that has happened is that RBI seems to show an enormous faith in corporate bonds. The Monetary Policy Report, in fact, speaks of far better transmission in CPs and corporate bonds, and not as far as banks are concerned. As far as the RBI sees them, banks are very recalcitrant players. But can corporate bond market really be a substitute for bank finance, particularly in the Indian context?
Mythili, I don't think bond market is going to be a substitute, corporate bond market is going to be a substitute for loans. But world over it works like this. Like Anant was talking about, when the risk is a little higher, the banks understand the risk much better. For example, construction risk or pre-COD risk in infrastructure. Banks understand it better. Number two, banks also have the wherewithal to monitor them on a more micro kind of basis, and also use their discretion on a case-by-case basis to acknowledge a better quality risk at some points in time within the portfolio, and those kinds of things. It's a micromanagement that is possible by banks, and they can give effect to this micromanagement through understanding of various portions of this whole loan process and accordingly price it and look at the risk on a micro basis and price it on a micro basis. So we should have a system ideally where pre-COD risk in infrastructure is done by banks. After that, let the infrastructure project run for a little while, and once it stabilizes, we should have a mechanism of transporting it into the bond market. So that way we're going to be able to transport the bank loans to bond market, free the limits here, free the capital here for the banks to take another risk, which is again more risky and which needs a micro kind of attention. Now this is one part, but more importantly what we need to understand, even in a general sense, bond market is only available for credits which we think are better credits, and for lower level credits like even mid corporates or SMEs, bond market is not yet an alternative. Even in the bond market, even for these large credits to move into bond market in a more stable kind of a way, we still need a lot of investors. Only the LICs of this world and the PFs of this world will not suffice. We need a broader market, and in order for a broader market to have, we need more liquidity. And in order to have more liquidity, these larger players like LIC and PFs, etc., should have a mechanism where they don't just buy up this corporate bond, put it in the HTM portfolio and just sort of sit on it. So the market price discovery and the discovery of the credit risk on an ongoing basis is not available to the smaller investors if trading doesn't take place. And the last point on this is we need credit rating agencies which are credible, and also credit rating agencies which have the kind of infrastructure and wherewithal to deal with this kind of a market. At the moment, they're just having some superficial kind of a thing. I dare say this because they do only CPs and short-term products, and long-term products in the capital market or the capital bond market doesn't exist. Or they don't exist in a big way. So their pressure on them to keep a watch on companies in these regards is much lower. You need a much larger infrastructure for them to be able to do this.
So much more needs to be done on the corporate bond front, but we're running out of time. But before I close, finally, let me ask one quick question to all three of you. Anantha in Singapore, what is your best bet on when the Fed will reverse and hike interest rates?
I think they might do so in December meeting, if at all they do so in 2015.
Okay, so is the view from Anant in Bombay any different? Anant, January, February, or will the Fed chicken out altogether?
No, I'm hoping it happens within 2015. Frankly, it will be a great sign if we can see a rate hike right away, because it will just tell us that there is no underlying bad story which we're not aware of, and that things are actually a lot better.
Okay, Vishwanath, you have the last word.
Well, the way the Fed chairman talked about her concern about what's going on in the emerging economies, and nothing new seems to be coming out in terms of a better story. I really don't know whether they'll be able to do it sooner. I think it'll be later.
Absolutely. So there is a clear difference of opinion on when the Fed is going to act. But clearly, as far as the RBI is concerned, we have got enough firepower with us, and hopefully the RBI will be proved right. But I'm afraid that's all the time we have in this edition of Macros with Mythili. Thank you so much, Anantha, Singapore, Anant in Bombay, and Vishwanath, as always, in our studio. Thank you also for watching. But we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.